The biggest area of growth for stablecoins is not in the US. And it is also the current largest area for existing stablecoins, but it will be the largest place of growth for stablecoins in the future as well. I would not be surprised if we're at 2 trillion in stablecoins, 1.5 of those are originating outside the US.
This episode is brought to you by Arkham. Arkham allows crypto traders and investors to look inside the wallets of the best traders, largest funds, and most influential players in the crypto markets today. We'll hear more about Arkham later in today's episode. Quick shout out to Permissionless 4 coming this summer to New York, June 24th through June 26th. We'll have speakers from all across the industry, including Hayden Adams, Kyle Samani, Guy Young, and more. Get your tickets today by following the link in today's show notes, and make sure to use code BELL10 to save 10% on your purchase. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another roundup of Bell Curve. You got Michael's 1 and 2, Vance. Fellas, no one's at Dubai. I can see each on the backgrounds.
Habibi.
What do you guys? Have you heard much about the conference in general? And then what is your feeling on Dubai?
What are you talking about? We're saving it all up for permissionless.
That's right. That's the right answer. But yeah, I caught up with Yana, who's over there at the moment. And it's funny, I talked with him the first day. He was like, Dubai's really cool. It's really clean. There's a lot of people here, yada, yada. Then the next day he was like, I have seen the underbelly of Dubai. I don't need to get into some of the nightlife, but yeah, it was a sheep that had like a pet bear and, other sort of tiger-like animal. It's just like, oh, really love to see that kind of stuff.
I respect the distance traveled for everybody, but
yeah,
no, we have too many important things to do here in San Francisco.
We travel a lot. No need to spend a super long flight.
Is ETA back because of AI in general? It seems, also just as a user of ChatGPT, just how much it's improved. I feel like every week there's a new model and it's incredible. How good this thing's got.
Yeah. I think I personally have had 6 friends move back from mostly New York, but other places all around the country who moved during COVID. Moved back the last 6 months, maybe 9 months now. Actually, 3 of them work at OpenAI, or now work at OpenAI. The city is busier. There's a lot more traffic. Restaurants reservations are harder to get. It definitely feels like the vibrancy of San Francisco is back in some ways. It's not. I lived here 2013 through 2016. That was sort of the start of the tech craze, let's say. It got really crazy in 2017, 2018. Fortunately, I wasn't here then. But I think that is definitely not where we're at. I liken it to kind of like the 2013, 2014 era again, where everybody kind of knows the direction where things are heading. OpenAI is going to be hundreds of billions of dollars of value that's generated, and their headquarters is right down the street. We walk out, of our office, and yes, 2 days ago, Johnny Ive and Sam Altman are filming a commercial in our lobby.
Yeah.
There's definitely a lot of stuff going on. AI is big. You can tell when it's YC demo day because this one coffee shop that we go to is packed with startup founders talking about how their pitch went. I think the tech scene is there was never really a chance that it was going to be anywhere else with real vibrancy, but it's definitely back in San Francisco.
Wait, so if Sam Altman and Johnny Ive are recording something commercial, does that mean that OpenAI is launching a hardware product?
I guess we can talk about this.
No, we cannot talk about this.
Give us the alpha, come on.
No. Look, they are, but they're definitely they were in a public space yesterday,
filming something together.
Yes,
we may have moved office.
Maybe it's an SF tourism video, but probably
we may have had to move offices down the street to our current office because of a campus being built with all the offices on our previous block.
Wow.
Yeah.
I mean,
that feels back. I would say the real estate market topped in like 2018. So there's like a definite bottom that has been put in, and if one of these
that long ago, not COVID, after it didn't stop after COVID.
SF topped like probably way before COVID, like just looking at like the price of different houses, but it feels like now the city is also a lot cleaner, which is good. Daniel Lurie seems to be a pretty good mayor, and I think that's good for everyone.
Nice. All right. Well, I'm curious to get your guys' take. Maybe we can start this week actually with something which was a story that didn't get nearly as much attention as I thought it deserved in crypto, and I'm curious to get your guys' perspective. And I know we've been talking about stablecoins a lot recently, but I think this merits some airtime here. So Quinn Thompson, shout out Quinn, found this report. It was a 20-page report from the Treasury on stablecoins, and there's a full link. We can link it in the show notes, but it only got 250 likes. And I'm just going to read a couple of the highlights here from the market overview section, which is, read this last quote. Evolving market dynamics has the potential to accelerate stablecoins trajectory to reach $2 trillion in market cap by 2028. So that is a 10x roughly from here. They make a distinction in between emerging tokenized money market funds via what they've been calling payment stablecoins. So USDT, USDC being payment stablecoins versus some of these next-gen stablecoins that look more like money market funds. I thought this was a really interesting tidbit as well. What are the potential impacts on bank deposits? And I'll just read this. The potential impact on bank deposits may depend on whether stablecoins are yield-bearing or if they offer other operational payment features relative to the yield and functionality offered by other products. In light of potentially exacerbated competition, banks may be required to increase interest rates to maintain funding or find alternative funding sources, i.e. expand their wholesale funding activity. So to translate what that means, banks might have to start paying depositors in the United States more because stablecoins are ramping up the competition, which I find so cool. And come on, this is the big stage, right? There's a $2 trillion potentially that the Treasury is calling for here, and it actually has a material impact on everyone that holds US dollars, which is everyone in the United States. So pretty cool. I'm not sure what you guys made of this.
Extremely bullish. I mean, look, when we're talking to RLPs or frankly trying to break down the market for stablecoins, what we prognosticate is that stablecoins in the next couple of years will hit 1 trillion. I don't think that I've ever seen a government agency, especially the Treasury, be more bullish than us on something. So that's pretty great in and of itself. It also called out the Genius Act as the proposed legislation. We have also heard murmurs that the Genius Act is probably going to be the form-fit regulatory construct that gets passed, also potentially with a timeline of before Memorial Day, which would be the end of May. I think that clears the path for basically all of this to start happening. We've heard murmurs that banks are basically like waiting for the day after that legislation passed for them to start opening up what they've already been building. I think this is going to happen a lot faster than people think too. And yeah, one question that I do have that remains to be seen is, and we've talked with advisors on this, and there isn't clarity yet, is what that yield bearing element looks like. So, BIDL, which is the BlackRock product, which is a tokenized money market fund, that may be an interesting kind of alternative to tokenized bank deposits if, let's say, the Genius Act, at least in the way that it's currently formatted, does not allow for payment stablecoins to be yield bearing. But if you have tokenized money markets or tokenized structured products, maybe those are the yield bearing ones. Like we need to have clarity, and what that act will hopefully provide is clarity around the market map of what is what, and the market structure for stablecoins. How can banks delineate between what's a tokenized bank deposit, what's a tokenized money market or yield bearing asset. But I think once we have that, it's a really interesting, secondary effect if you can tokenize all of your cash in your checking account and just transfer it into a tokenized money market as you're waiting to be able to, pay bills with it.
So, you know what is sort of making me laugh a little bit here is that, I mean, there was actually someone pointed out, it might have been Austin Campbell, who's been, by the way, you should check out his just commentary on stablecoins in general. He's been pretty involved in the Genius Act. And I think it was him. So I apologize if I'm getting his attribution off, who was mentioning that when money market funds were originally proposed, there was a lot of resistance to them, actually, especially from the banking community and the regulators, because of this concern that passing back yield towards, to holders of a money market fund would put pressure on the banks. And so it's interesting to me to see this exact same concern crop up. And, there's good reason for this. I think that it would cause some issues by causing, issuers of stablecoins to compete on yield. But they have there's a whole section here around the rapid growth in digital money market funds that's catalyzed an alternative stablecoin narrative despite obvious differences. And they break out tokenized money market funds from stablecoins. And they have all these things: target users, select use cases, payment tool, redemption model, issuers, and the yield bearingness. And it just basically is just, it's a money market fund if it earns returns based on the underlying assets and are yield bearing. And under the proposed Genius Act, stablecoins cannot be yield bearing. But there is yield that's being generated. It's just going to the issuer of the stablecoin. So it's an interesting thing. Maybe there's a little bit of path dependence in terms of how the banking system developed in the US. And, stablecoins are throwing a little bit of a wrench in people's preconceived notions about the separation here. So
I'd love to see them put this into force and then create a swap line for stablecoins. Like if you got paid, 50 bips above SOFR to hold and distribute stablecoins, you create this natural incentive to actually dollarize people. That would be a very interesting financial primitive to go alongside this. And, we have swap lines to different countries for their currencies. I think this is kind of a different variation of that. But, there's not only a way to put this into legislation, there's a way to put your foot on the gas and really distribute the supply of US dollars.
This was one other, so exactly to that point, so one other interesting tidbit from this executive summary was, so what are the potential consequences for the Treasury market of stablecoins? Two main potential impacts of deposits moving to stablecoins: an overall increase in demand for treasuries, which I think everyone has intuited, but the other is an overall shift to the front end of the curve. So for something like USDC, they're almost entirely collateralized with T-bills, which are very short-dated treasuries. And so that's kind of a powerful tool for Treasury, because if you have more demand for, short-term dated debt, then, you can afford to not basically dump duration onto the market and raise longer dated yields, right? Which is where people fund mortgages and things like that. So it's actually a really, really useful tool in their tool belt, right? So
I mean, it is, but if you're going to go all the way to the front end of the curve and not be able to do things I think it reads that it says they have to go to the front end of the curve and just buy basically CDs or very, very low risk instruments. If they're asking to kind of do that, I think the natural thing would be to give them incentives. Call it some sort of program, like the stablecoin reserve program. Start funneling incentives towards that. I feel like the only way that you can actually do something like yield curve control mechanically is if you kind of create the incentive market yourself. It'll be so operationally difficult to do if you're just kind of spraying and praying into CLOs or the 10-year or something. So I think that's kind of another interesting monetary policy lever you can pull.
definitely, yeah. I know we've talked about it, but I do think that this model of stablecoins look something like, it's not originally what narrow banking was, but kind of like that. It's the way I sort of look at these stablecoin issuers now is they're kind of global bank deposits with very low overhead and much safer, more liquid base of assets. And it's kind of a cool model. And it's an interesting building block. Instead of the IOU being tethered to a certain bank, it's just kind of global from day one and building blocks that anyone can use. And people are. And there's a whole next gen. And I do think the Treasury is right to make a distinction in between stable coins and assets like USDE, like Athena, or some of the, or Level or Cap, kind of as being new stable coins, right? Which use USDC or USDT as a base to a collateral asset to generate yield. Or in the case of Athena, it's more like a tokenized hedge fund strategy. Like those things do feel different to me than Tether or so. I don't know if you guys feel the same, but those feel like different things.
There's algo stable like history. This guy Feng Piao was the first guy to ever create an algo stable in like Imperial China. It was backed by silver. Like it's kind of like it's making this stuff interesting again. All these different models. It'll be interesting to see what happens to the investment banks as well. The ones who are providing services to this stuff, like Janus Henderson is putting their AAA CLO on chain. BlackRock obviously has Biddle. Like I expect a bunch of these people to start coming out with things that will benefit from stablecoins.
Arkham was created to make blockchains human readable and simplify blockchain data so that it is meaningful and useful to the average crypto user. With their new exchange, users can see what the top traders are buying and selling with Arkham Intel, and then trade on that information with Arkham Exchange. To get started, follow the link in the show notes below. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. Something that I'm reminded of here, and it's an interesting sort of moment in time, I think, is, there have been a couple of headlines this last week, which would have been, beyond your wildest dreams 2 years ago. And the market sentiment is still in the dump. This announcement from Treasury on stablecoins, there is an $8 billion Bitcoin strategic reserve bill, which I don't know the inner workings of this, but I guess the governor just has to sign it in Arizona. I also saw Charles Schwab, the CEO, came out and said, within the next 12 months, we want to roll out spot crypto trading. I mean, these are huge developments, right? I mean, just the Schwab announcement alone, they'll probably do a staged rollout. It's not going to be all on day one and might end up taking longer than, we want it to. But these are crazy developments, right, in terms of adoption here.
It's crazy. It takes a year to roll out.
Yeah. It's crazy that they're a year and a half behind BlackRock.
But it's good that they're doing it.
I mean, we were just saying this in our office right before this, but it has never been more bullish from a fundamentals perspective, but it does not match where the rest of the market is. And, talking with other people in the industry and partners of ours, they're seeing the exact same thing across the board, which is like, if you really dig into some of the things that have tangible value, the fundamental flows of revenue and income to some of these protocols, the institutional adoption and financial institution adoption of these assets, and some of the, I would say, complexity or product capabilities that these new companies are being able to support, just open up the field for what you can do with this stuff. It is fundamentally bullish everywhere. You just have to look, but it hasn't translated into price yet.
We made a great slide comparing like these things to traditional I don't think we can show the slide.
No,
compliance will probably get mad, but it is quite compelling. But the person that we just met with just said like people don't get this stuff at all.
And the basis of the slide though is you compare some of these protocols with some of the comps of publicly traded companies in the public markets. You compare the headcount, and we're talking about like 10 to 30 people working at these protocols versus all of the comps that we had were over 1,000, but typically like multiple thousands of employees. They've been all around for like 12 to 15 years. They were started, the earliest ones were started in like 2012, 2013. The most recent ones. The earlier ones, like a PayPal, was started in 1998. And sure, they're highly valued, diversified businesses in some cases at this point, but some of them are not. And some of them are, comparing a protocol asset with a company, the growth is multiples higher. The profitability is orders of magnitude higher. And it's because these protocols can operate with such small OpEx compared to companies. and have the same distribution, the same type of value accrual. It's just very fundamental. And so we've started to incorporate this into our discussion. Whenever we're talking to our investor base or peers in or people in the investor group, and that's what resonates best. It's just you compare a protocol to a company, and there's really no comparison.
You know what else I find a little bit funny is that when you listen to people that invest in public markets professionally, their complaint is that there's no scale left anymore. This is all just passive flows, and there's no sense of value, and all the passives just buy the big Mag 7 and yada, yada, yada. Well, crypto should be a welcome tonic relative to that environment, right? You can actually just get alpha by straight up talking to teams, right? Like, that is, if you just dug and found good teams, there is value lying on the floor in crypto, probably more so than there is in almost any other market that exists in the world today. So I've started to feel like that when I listen to these guys complain about passives. It's like, well, you should love crypto then, because this is an active manager's dream. It's hard. It's not easy at all. You guys are one of the best at it, but the opportunity is there, right? It's what people say they want.
Yeah, if you're in the forums, you're gonna make it. I think like I'm back in Discord, which is also funny. It's like the cycle has now come full circle. But Mag 7, I would say those are like SAS is different. Like Mag 7, Michael and I were discussing this. It's like they are the best at what they do. They have the most scale. They're growing the fastest. They're most levered to the future. Like if you're doing something other than the Mag 7, it better be very important for you to go public. Like the IPO window has been closed, and so the Mag 7 are the only game in town. Crypto, to your point, it's just like it's an open field, and sometimes if you don't know what you're doing, you can over extrapolate. And basically, that's how something like an OpenSea gets like a 13, 14 billion valuation. But I do think you have to be ready to lean into behavior that you think is sticky, that is generating fees on chain that you can reasonably forecast.
So here's one thing too, which is, thinking about this is just a dashboard that Electric put together on stablecoins. But, this is the circulating supply of stablecoins, which is basically up only here. And, I'm thinking to myself, okay, what are the implications if this number is first of all, it doesn't go down quite so much, right? It did dip from 170 some billion to maybe 125 or something like that, but relatively modest dip. And what happens when there's $2 trillion worth of stables that exist on chain? It's basically, if you don't have, it's basically going to be cheaper demand or cheaper borrow, right? One thing that we haven't really rebuilt, and Galaxy Digital did a good job of highlighting this and gathering some of the data, is we never really rebuilt the credit complex when it comes to crypto. And so, yeah, if you have $2 trillion worth of stable coins on chain, all else equal, you're going to drive down the cost of borrow. And so you should increase leverage, right? And these dollars are pretty sticky. They don't really move. I'll actually show you a chart as well.
If there's 2 trillion of stable coins, that means that there's probably 2 players with 500 billion and 1 player with $1 trillion. Like those can be like Google-sized outcomes if they monetize anywhere close to where they are today, which is, I would say on the low end is Circle at like 100 basis points. At the high end is probably something like Sky, which is 400 basis points.
Well, the high end is Tether.
Well, yeah, the high end is Tether, but it seems like it's like 30 or 40% for them each year. But I would say going forward, like if those are $500 billion stable coins, what is the value of that business? At 200 or 300 basis points, that's like 10 to 15 billion. That's a lot of earnings.
It is. And that's actually, people often say in crypto, especially on CT, it's like, how do I play stable coins? I mean, there is an obvious answer. First of all, there are stable coins that have their form of equity, right, or token associated with them. There are also borrow lend protocols that seem like pretty straightforward place in this as well.
Right.
This is what I mean about value on the table, right? Like it's right there for you.
Look at the Maple too. Like
right. Where do the stable coins go? They flow to borrow lend, money market, lending protocols, basically any place where you have a relationship with Sky right now that's allocating capital into some of these protocols. You have a relationship like Spark or Aave or Morpho. I mean, there are just so many examples of, okay, there's the direct beneficiary, which is either going to be the issuer itself, and then there's the secondary beneficiary, which is going to be the recipient of the actual assets. The secondary one, I think, that one hasn't been played out yet.
I mean, these are net interest margin businesses where basically you are tolerating unprofitable carry trades for a short period of time and then trying to find like longer duration or more incentives or a different credit mix. And I think that's why being a US stablecoin will be a separate thing. Right. Like everyone will have their own US branded stablecoin. I think that's in the cards, but they don't want to give up the ex-US.
So just to further this point, one thing that isn't as clear in the Treasury market, but I think should be Treasury market presentation, but should be called out is the biggest area of growth for stablecoins is not in the U.S. And it is also the current largest area for existing stablecoins, but it will be the largest place of growth for stablecoins in the future as well. I would not be surprised if we're at 2 trillion in stablecoins, 1.5 of those are originating outside the US. It's not going to be like, we don't need stablecoins in the US as much as people who are not accessing the US financial markets or financial services that we have need stablecoins. And so it will be, I think, a lot easier, for that growth model to potentially, outside the US.
Over the years, we have seen a multitude of hacks, rugs, and bundled launches. The number one way that crypto traders can protect themselves and the wider community is through on-chain analysis, knowing who is moving funds and where those funds are going. Paired with their new exchange, users can see what the top traders are buying and selling with Arkham Intel, and then trade on that information with Arkham Exchange. Arkham's exchange provides traders with the tooling and liquidity to take action in crypto markets based upon their on-chain observations, bringing them the world's first exchange powered by crypto intelligence. To get started, follow the link in the show notes below. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today.
Okay, on that point on just ex-US in general, is one thing. Okay, actually, this is what I wanted to ask you guys. Do you think, as a hypothetical, so a lot of these stables right now are issued on Ethereum, Tron, a little bit of Solana. I think it's much lower in Solana. It's like 10 or 12 billion or something
growing, like that. But it's still probably 10 to 20 billion.
Yeah. Actually, here, I've got a chart on this. And actually, the interesting thing about it as well, which one thing that I think is worth pointing out is that crypto activity is weirdly stickier than you would think it would be. Like all of these stables, you can see there was a big jump post. This was with the Trump stablecoin launch here in stables. And it didn't really drop off after activity dropped off. Like if you look at the DEX equivalent of this chart, it's there's a big spike and then it drops way lower. So it is worth saying that, yeah, the stablecoin stuff.
Wow. Yeah. That's a candle, a stablecoin right there.
And so there's probably a strategy, right? And I know a lot of these foundations and L1 and L2 teams are really concerned with getting stablecoin and RWAs on their platform. I think it's interesting to think about, is that actually good for Sol, the token, or ETH, the token? Especially if the value proposition is, we want you to hold this as store of value or medium exchange or money within my ecosystem. Aren't stablecoins directly competitive with that as a use case? What do you guys think about that?
Yeah, I think there's an argument that is the case, that a governance token attached to a stablecoin is the dominant fee creation model, alongside maybe like perps attached to a stablecoin, perps attached to a governance token. But Ethereum still does, 2 to 3 billion a year of earnings. And so like it is a long distance to get there. Like you basically have to 10x your revenue from it'd be like an 8x of revenue from like a Sky perspective. For Hyperliquid, it would probably, 4 or 5x. So, I mean, we'll see. It's certainly possible. Also possible if the L2 and L1 scaling roadmap actually get fixed, that is not the case. So we'll see. It's just like the question of which fees will grow quicker.
I kind of think like ETH is still one of the most dominant assets in terms of borrow lend.
It is the asset that powers most of this.
Right. And I think, but it hasn't really had the medium of exchange narrative basically since NFTs died after 2021. I think Solana kind of had that with meme coins up until earlier this year. And because it was meme coin to Sol as all the pairs. And so I less believe in the, like, these are going to be the assets that people use to pay for things on chain. I do view them as collateral assets where you have a long perspective and you want to borrow against it for, liquidity purposes or whatever. But I do eventually think that, value accrual, store of value, or kind of like a new type of value mechanism, but less medium of exchange is how I would look at the base layer assets.
Yeah. I think that, we probably have enough information at this point to do some sort of, because these L1s are, I think a lot of the tokens that you look at today, you can pretty much look at it as some form of pseudo equity. I don't know if it's like, these are companies, right? Like mostly. But L1s are obviously not that. They're clearly something very different. So yeah, I think that there's a lot of arguments around how do you value these things? What metrics should you be looking at? There's this whole strategic Ethereum pivot that's going on in real time. And I've noticed that for whatever reason, whenever someone suggests a part of this valuation methodology, people are like, oh, well, if you only focus on this, then why? When in reality, there's a lot of different components to that, right? There's probably a liquidity component to something like an L1 token. I do think REV or fees or whatever is a component to it, right? There's kind of all these different things. And then even within liquidity, you can break it down in terms of, there are different characteristics that you'd like to see. And for the fees that the L1 is generating, is it based all on meme coins? Because you can decide to discount that, right? You can say, I think this is unethical, or I think it's not durable, or whatever it is, and you can have your own discount methodology. But it is funny to me that the discourse in equities and fixed income is so sophisticated, and whenever someone suggests like one metric, it's like, oh, well, if you only care about this, then why? It's like, no, it's just a component to it, But
there's different sectors as well. Like you own Bitcoin and ETH, and we do, for different reasons than we do the mid tail of altcoins that are doing earnings and buying back their own tokens. I think there's like market beta, which is kind of the majors, and then there's like the asset alpha, which is the more idiosyncratic names. But I feel like most people in crypto also follow that barbell.
Yep.
Yeah.
But I do find that a lot of the coins that I see on the timeline I've never heard of before. Like someone tweeted out his portfolio, I was like, what are these coins? Like there's just a different meta that's occurring adjacent to what we're doing. But I wonder how connected like the daily runner culture will be to like ETH gets institutionalized as an asset, and like you bring all this private credit on chain and these stablecoins, go to 2 trillion. Like it'll be in parallel.
Yeah, and I'm pretty sympathetic to the idea that, okay, you have some there might actually be this weird messy middle period for ETH where more stablecoins being issued on ETH rails competes with the medium of exchange type value proposition. But I do think if buyers in their head can translate stablecoin activity into fees, then I think that's a bullish case, right? Because just intuitively it feels like, yeah, if you have a bunch of stablecoins which everyone is using that are issued on this, within this ecosystem, that feels like it should be valuable. And I think if you could see that transfer volume of that activity translate into fees paid towards stakers, the L1, then I think that would be good. I think people would.
I do think like a very bullish view on just like stablecoins are minted on a chain today. Why is that bullish for the chain? Like Robbie Mitchnick, the head of digital assets at BlackRock, had a quote where he was just like, look, that's the only place that people seem to be willing to take this type of risk. There's a $5 million minimum on the BlackRock Biddle product. So, like ETH has a natural strength of like very deep capital markets because the asset, even though it's smaller than Bitcoin, is still used more in DeFi. And like that creates liquidity network effects, which draw things like stables or yield products. Like it's all connected. And yeah, I do think there is like a lot of the bull case for ETH right now as well is just like how deep its capital markets are. That like I don't think we would ever move to a different chain for the most secure stuff that we have to do. So yeah, that's kind of another aspect.
Totally agree. Well, here's another. Okay, let me know what you guys.
A finer point is like the incentives for you to mint on a different chain are like low single-digit millions. Someone might throw tokens at you, or maybe there's like a fee discount or something, but that's oftentimes not enough to like push it there. And like people think about like the figure credit stuff that's happening on that chain, or like the mirroring stuff where it's like, yeah, those are on chain, but they're not like really issued here.
Okay, I've got another. So I agree with that, and I also think that one of the advantages that ETH has. Monet Supply pointed this out and said it more eloquently than I did, but there is, the negative way of framing this is there's a lot of capital on ETH that's not necessarily getting a super high return at the moment. So you could look at a narrative like restaking, but that's a huge advantage for issuers that are looking for cheap funding. And let me give you an example of what I'm talking about here. So there's a new stablecoin called CAP. This is kind of one of these next gen stablecoin or money market funds like designs. And what they're doing is they're trying to generate yield on, I believe it's USDC and USDT. So the way that they frame this is this is their phrasing, right? But there are three ways of organizing a stablecoin. One is authoritative, where you have one team, which is basically creating something like a hedge fund like strategy, like Athena. And that's where yield is coming from. And there are depositors that's the strategy. The governance is you have a team that's competent. Then there's sort of the, forget what they call it here, but there's the Sky model, right? Which is that there's a DAO that's organizing different units of capital generation, and you can allocate across those different units. And then there's another more market-based mechanism in their design. I'm not going to get into the specifics here, but where they have USDC and USDT, they bring in professional, what they call operators to generate yield there. And then there are end users who deposit. And to ensure that the operators are incentive aligned to the end users is they take restaked capital. And so the advantage, is this actually really interesting because there's $10 billion of TVL and Eigenlayer. I'm not actually sure what the current number is, but the big challenge is what are you going to do with all of that capital? Because we're not going to secure Cosmos chains, from long range, whatever attacks. So instead we need to figure out something else to do with this capital. So it's essentially going to be first loss capital for these operators who are leveraging, finding yield with USDC and USDT. That's an opportunity that actually only exists within Ethereum. Now,
yes, ETH1 is still the only place for like very big financial experiments.
Yeah. Now, the challenge for that is that that's a completely radically different risk profile that most users probably thought they were getting into with restaking, and you're kind of providing first loss capital for probably a very low percent yield.
The yields on restaking never got high enough for people to blow up on a carry trade with them.
Yeah, right.
Which is kind of funny too.
That's what everyone was concerned about. Remember, restaking was the black swan that was going to take it down at some point.
Or it was like Lido centralization.
That one was that was a crazy narrative.
Crazy security test. No more. No more like this, please. I'm glad we're going in a different direction now.
This episode is sponsored by Citrea. Citrea is the first zero-knowledge rollup to enhance the capabilities of Bitcoin blockspace, enabling Bitcoin applications and unlocking Bitcoin's full potential as a programmable financial platform. With Citrea, developers can now tap into Bitcoin's liquidity to build scalable payment systems, privacy solutions, and more. Citrea is currently in its testnet phase and is approaching its mainnet launch. To learn more about Citrea, follow the link in today's show notes.
One more, I know we don't want to talk about this too much, but there was some investigative work done from CoinDesk on Rishi, Mancha, and the folks at Movement. So, just reading down some of this, there's been a little bit, there's been...
No comment. No comment.
All right, we can skip this part, but yeah, I mean, I do think that this is what we were talking about with Santi maybe 2 weeks ago, is we could definitely afford to do better in terms of transparency in the industry.
Who's building the disclosure, regime? Who's building transparency around what these market maker contracts are? Who's building transparency around what the team has and what wallets they're in, and confirmation that the smart contracts that tokens are being held in actually have a vesting component? Who's building that? Because that's what we need. And it's either going to come from a new regulatory standard that gets put through, maybe with market structure, or the other option is we could go like the financial services industry does and self-regulate.
I agree. Here, one point.
Ipo, you want to be the sheriff?
Yeah.
No, I'm all right. But you know who I think actually, okay, so I think that the exchanges have to play a part here. And the evidence that I'll point to is when CoinDesk broke this reporting that they brought receipts and all this stuff, the price of the token actually went up, which is everybody's very frustrated about, right? But when I think 24 hours or sometime today, Coinbase announced that they were delisting Move, and now the token's down 20%. So I think that tells you everything you need to know.
Well, yeah. The problem is that if you rely on the exchanges, their incentive is volume. They're not going to want to limit, assets and until they're being told that they need to. Like, they're publicly traded companies, they're for-profit businesses. Like, they won't abide by this unless they're told that they need to. I honestly think that this is self-regulatory from, the protocols themselves, and where you can kind of have this, and maybe I'm biased because, this is our perspective, but like, if we're going to get into the depths of, let's figure out what this asset is, if we're going to buy it or we're going to invest in something before it exists, like, we want to know that there's going to be, the safeguards and standards that has helped us evade so many of these, what now look like, nefarious actions on many different investment opportunities that we have passed on. But we haven't, because we, do really deep diligence. If we were to take that perspective and apply that in a public manner and say, here's how we're approaching this, here's what we're disclosing to the community, here's what we're, talking with the team about, what they should and should not be doing, how they evaluate market maker deals, how they evaluate exchange deals, how they evaluate what they should be doing from a staking locked tokens perspective, like whatever these decisions are, this is what we focus on with them. If we did that in a public manner, I think that would engender confidence that would probably get them more capital. And then it becomes a positive reflexive loop where you do things in the positive sense that gets you more capital, which you look better, and then more people want to do this as well. Like the punitive, if you don't do this, we won't list you kind of thing. I just don't think, I frankly, unfortunately, have zero confidence that Coinbase is going to do that, especially Binance is never going to do that.
Wait, so I thought that too, but can I, look, this might not be the case, but they do have it in, what Binance and Coinbase don't want to do is list stuff that goes down only. I think they do have an incentive not to do that. Maybe, like there was a period of time where, from my understanding, Binance became sensitive about being exit liquidity for meme coins. That was a real pain point for them, right? That was like, okay, it started trading on Pump Fund, then it graduated into Radium, and as soon as you got the Binance listing, everyone dumped. And they didn't like that.
Totally. But if Binance and Coinbase knew which assets were going to perform, they would have the best venture arms. So
well,
they have a venture arm and they have invested in basically everything. But I guess my point is, like, you can identify outright scams. You don't want those.
You're right.
It's hard to identify something that's like a mid-tier asset that looks and feels from the outside looking in like it's going to be great, and it goes up 10x, whereas one of its competitors like stays or drops 10% or 50%. I think it's really hard to evaluate this stuff, like it in terms of what will perform. So yeah, I think it's on the capital allocator side, especially at the public token element, token treasury purchases.
Yeah. I got one more. Yes. Okay. Maybe I got one more thing on. This was an interesting headline that I guess almost was technically this week, which was Ripple was considering an acquisition of Circle for something that looked like $5 billion. I'm curious what your guys' take was on that.
If I'm Jeremy Allaire, I probably don't take the Ripple equity and tokens, which I think it'd probably be mostly equity, or maybe it's tokens. I don't actually know, but they're doing the AOL Time Warner, where they take the funny money and they buy real assets, and they could end up with quite a treasure chest here at the end of the day, and they could become like a very serious player overnight. Like that's why Ripple is valued so highly in my mind.
Yeah, it's kind of interesting. We talked about Hidden Road, the acquisition that did end up going through. They process some crazy amount, $3 trillion and something like that of trades per year. And, as we were just talking about, it's strategically valuable for environments like Ethereum or Solana or Ripple chain, right? To have a bunch of settlement and fees happening on it. So it actually makes a lot of sense to me they have their own competing stablecoin, I think.
It's on ETH.
Okay. Yeah, that's
right there.
It's in a curveball.
But you could see, right, all the cogs turning in Ripple's. That makes sense as an acquisition. Buy a massive prime broker and then buy a massive stablecoin.
I mean, what Ripple is worth is in the eye of the beholder,
Or the eye of the beholder of the last round valuation, which I think was 10 billion.
Oh, yeah.
There's a lot of companies that are just working through their private markets and doing this. They're buying very valuable assets, and it's a weird venture PE hybrid strategy, but it's interesting.
Like, say more. What is?
I mean, like OpenAI's worth $350 billion. They bought like the number 2 code generator, Windsurf. There's like a lot of people that are pretty highly valued that are like, CoreWeave bought weights and biases or some like AI, Copilot shop. But yeah, it's a highly valued company right now.
There were calls on Twitter that OpenAI should buy Snap yesterday.
I saw that.
Right.
Wait, Michael, what do you think about that? Give us your take.
Well, if any of the publicly held shares actually had voting rights, maybe that would be a real consideration. But given that it's Evan's call, literally just Evan's call, it's never going to happen.
What is Snap valued at right now?
Not much.
Like $6 billion?
No, more than that.
More than that?
20 something.
13.
Wow. I hadn't checked it in 2 weeks.
When did Michael leave on the chart? 77? No, you left it like
I left literally as the IPO lockup was ending.
Goodbye.
It's a pretty good example of corporate governance failing and why it's actually important. Like,
this was going to be like Mark Zuckerberg fever round 2. They were going to really go head to head, but I think it wasn't dialed in enough.
Yeah. First New York Stock Exchange stock where the stockholders have zero governance rights.
Yeah. And I mean, Michael, you probably have a better sense having worked this out. I've always heard Evan Spiegel's a great product guy in general and really talented there. But it's kind of hard to operate in the space that he's operating at and do nothing. The stock price is down, I think, on a 5-year time price.
It is difficult. It's
down 53% on a 5-year time horizon.
Wow. It's difficult, if not impossible, to be a subscale advertising business.
Yeah.
And basically everybody that I used to work with has left. So I don't even have friends there anymore.
Yeah. All right. Well, shoot, I was going somewhere with that, but I can't remember. So we have let's talk about Unto. This is I'm not sure how much you guys can talk about it, but Unto is this is Liam Heger. So he is one of the founders, I believe, of X Framework fame, and also Jump as well, right? So he was working on the team at Fire Dancer, and then decided to launch his own L1. I'm blanking on the name of his business partner. I'll find it. Will. And the idea is that this is obviously, I think actually there was a small lawsuit there for a second, which has been dropped. But yeah, it's basically, some of the smartest minds behind Fire Dancer are launching their own new L1, presumably based on some amount of lessons learned, or presumably based on some insight that wasn't, couldn't be adopted in Fire Dancer for a reason. That's why.
Yeah, you're working on something and worth something when Jump files a lawsuit to enforce your non-compete.
Yeah,
and
now they then settled,
which is now completely settled and totally done with. But yeah, we're very excited. Liam worked at Framework specifically on the trading operations that we used to have, and then that actually spun out as well a few years ago. And then he joined Fire Dancer to Jump to lead the Fire Dancer engineering operations. And yeah, just has a better idea of what he thinks they can build versus what he's seen in the market. And I believe he's already said that so it'll be the Through blockchain. Onto is the name of the company, but Through, THRU, will be what it's called. And the Through VM will be a RISC-V based VM. Which is what actually Vitalik came out, I think this week or last week, and said maybe we should consider this for a new upgrade for the EVM.
Yeah, Liam is super talented. He's been working out of our office, and we're super excited to see him go live.
Yeah.
What do you guys think of that proposal, the RISC-V VM proposal from Vitalik there? It's kind of an interesting, the idea just being, if everything is getting translated into the EVM, it would be more efficient, right? Sometimes by, almost 2 full orders of magnitude to just have RISC-V be the dominant VM on Ethereum. Yeah, I'm curious what you guys think about that. That was an interesting.
I love that they're actually calling out some of the sacred cows. I don't have enough information to know whether or not that's going to be a better model for where it is currently, or what's potential by the time they would implement this. And that's kind of the key point, which is like, this is great. We're talking at minimum 2028.
Totally. Okay, here's something that I've had a lot of trouble reasoning about. I'm not 100% sure how I feel is you would be giving up the EVM dominance, right? Which is there are strong network effects that are associated with the EVM. And I don't really have a clear mental model for how that translates into something like ETH price, right? Like Avalanche is an EVM chain. So is that good, bad, neutral? How does that?
Cosmos and IBC are, and I know it's not the same comp, but like, how much does the Cosmos and IBC capabilities, technical integrations, actually translate to the Cosmos coin? None.
Not at all.
I don't think of it that way. I do think that there is maybe a philosophical or sort of like a community-oriented element of having alignment around the EVM that does benefit in secondary ways, or potentially even tertiary ways for Ethereum itself, which is just like instant integration, same address convention, like that. All of those things I think add value ultimately, but it doesn't translate directly. That's how I would put it.
Yeah, I guess kind of intuitively like. Yeah, you would like to be, you're probably de-risking from the perspective of devs, right? Like if I'm taking the time how to learn the EVM, that if it's widely adopted on a bunch of other chains, there's not going to be some platform risk of learning. Like this has been the challenge from my perspective, Starkware, like Cairo or something like that. But yeah, I don't know. Anyway, it's interesting to think about. And yeah, that's basically all I've got this week. Anything else that week? Do you want to make this macro podcast for 5 minutes? Touch on the state of the markets and kick up some whatnot.
I think we'll leave without the macro today.
I think that's good.
Yeah, no matter what we say, we'll be wrong one way or another.
Yeah, I know. Yeah, it'll be completely different by tomorrow. So. All right, guys, this was a fun one. Appreciate you both. See you next week.
Later.